All right, let's jump back in time to a pretty wild, almost forgotten chapter of American financial history. Now, why are we doing this? Because believe it or not, what happened back then holds some seriously sharp lessons for anyone trying to make sense of today's crypto markets.
I mean, if you're in crypto, you're no stranger to chaos, right? You've got thousands of tokens, new protocols launching and failing every week, and you're constantly trying to figure out what's safe and what isn't. But what if I told you America has already run this exact experiment, just with paper and ink instead of blockchains?
Yeah, you heard that right. By the time the Civil War kicked off, the United States had over 10,000 different totally legal banknotes floating around. Every single one was issued by a different bank, each had its own unique design, and, this is the crucial part, each one carried its own level of risk. And this wasn't just chaos, it was actually a system.
So, welcome to the free banking era. For about 25 years, from 1837 to 1863, America just went for it with this radical experiment. You could really call it the country's first real attempt at what we now call permissionless finance.
So, how on earth did this happen? Well, it all started when the charter for the Second Bank of the United States, think of it as the central bank of its time, wasn't renewed in 1836. That left this huge power vacuum. And just as states started cooking up their own banking rules, bam, the Panic of 1837 hit, basically throwing these brand new decentralized systems into a trial by fire. Over the next quarter century, 18 different states passed these free entry laws, creating this incredible patchwork of monetary systems all across the country.
And this quote just perfectly captures the mood at the time. This whole thing was fueled by this deep, populist distrust of any centralized financial power. President Andrew Jackson famously called the central bank a hydra of corruption because he thought it gave a handful of elites way too much control. His war on the bank is what accidentally kicked off this entire era of decentralized money.
Okay, so how did this system actually function on the ground? I mean, how could you possibly have thousands of different currencies without the whole thing just collapsing into a giant mess? Well, the mechanics are going to sound surprisingly familiar.
At its heart was this idea of permissionless finance. The key thing was, you didn't need a special favor from a politician or some exclusive charter to open a bank. Nope. If you could meet a clear, publicly known set of requirements, you were in business. It was all about replacing political connections with market entry.
And here's the basic playbook in 3 steps. First, if you wanted to start a bank, you had to deposit some assets, usually state bonds with a state official. That was your collateral. Second, based on the value of that collateral, you were allowed to print and issue your very own banknotes. And finally, and this was absolutely crucial, any regular person could walk into your bank at any time and demand to trade your paper notes for actual gold or silver. That redemption promise was the ultimate backstop for every single note's value.
Okay, now this is where things get really, really interesting. When you put the mechanics of the free banking era side by side with today's crypto and DeFi world, the parallels are just stunning. Just think about the information problem. Back in the 1840s, how would you know if a banknote from some bank 500 miles away was any good? Well, you'd check a banknote reporter. These were weekly newsletters that were literally the coin gecko of their day, tracking the value and health of thousands of different banks. Today, we use on-chain analytics to do the exact same thing, figure out the risk in a huge, complex, decentralized system.
And get this, they even had a version of crypto's liquidity problems. A banknote from, say, Ohio was actually worth less in New York City. Why? Because it was harder and riskier to travel all the way back to Ohio to redeem it for gold. They called it a distance-based discount. We see the same exact idea today with liquidity distance, where a token might trade for a little less on a different blockchain because of the costs and risks of bridging it back to its home chain. It's the same logic.
And finally, you have the pricing of risk itself. In the big financial centers, you had these note brokers who created a dynamic, real-time market that priced the risk of every single banknote out there. This is precisely what a smart DeFi user does today when they're looking at a protocol's total value locked, its audit history, or the yields it's offering. In both eras, the users had to become their own sophisticated risk managers just to survive.
But let's be honest, this system was far from perfect. A lot of these banks failed, and a lot of people lost their savings. The easy explanation that people usually give is that decentralization was just too chaotic. But when you dig into the data, the real reason is so much more useful.
And you don't have to take my word for it. Just look at this chart. It compares 2 of the state systems during a financial crisis. Over on the left, you have New York. When banks there failed, the note holders got back an incredible 99 cents on the dollar.
But look at Michigan on the right. They got back only 40 cents. That is a staggering difference. So what was going on?
And here it is. This is the absolute key. The success or failure of these decentralized systems had almost nothing to do with decentralization itself. It all came down to one thing: the quality of the collateral. New York's law was super strict. It demanded that banks use high-quality government bonds. Michigan's law, on the other hand, was loose. It let banks use sketchy real estate mortgages. When the crisis hit, the system with strong rules and solid assets held up. The other one, well, it completely fell apart.
So this brings us to the big question. What can we, as people navigating the world of digital finance today, actually learn from this incredible historical experiment? I think it boils down to 4 timeless lessons. First, quality trumps ideology. The best system wasn't the most decentralized. It was the one with the smartest rules. So judge a protocol by its actual mechanics, not just its buzzwords. Second, information creates alpha. The people who made it through were the ones who did their homework. Third, diversify your systemic risk. Don't just own different tokens on the same blockchain. Spread your exposure across different ecosystems. And finally, strong rules always win. Over the long haul, money and users will always flow to the systems that are the most stable, transparent, and reliable.
And that really is the heart of it all. The people who succeeded back then weren't the ones who just blindly trusted any piece of paper someone handed them. They were the ones who taught themselves how to analyze the institutions behind the money. And that lesson is just as true today as it was almost 200 years ago.
I really hope this look into the past gives you a clearer lens for looking at the future. This Explained was based on research from the Druid Deep Dive, and it's presented by Sagic's Apothecary. They specialize in crafting portfolio strategies by digging into the wisdom of financial history. Thanks so much for joining me.